So without further ado, I'll introduce session number 2, which is overcoming volatility with a simple and proven technique. And for this session, I'm going to invite onto stage a very old friend of the CFA Society here in Indonesia, with 25 years experience in financial markets and the globe-trotting leader of AgroDana Futures. I'll invite Mr. Tommy Zhu up on stage. Thank you.
Good afternoon, ladies and gentlemen. Thank you for your time coming to the CFA Institute conference. And I would like to share about overcoming volatility with a simple and proven technique as our second session. And please allow me to move around the stage, as I may get cramped if I just stay on the same point for 1 hour. Thank you. Okay, so maybe you have seen my profile that I have been in this industry, in financial market, for over 25 years. And just like Mr. Wong mentioned, what he explained, actually, it happened all the time in the market. And the trend is always repeating. So market psychology is important. And now we would like to discuss about how to overcome this volatility. Normally, when we think about volatility, it always reflects as moving up, moving down. So volatility is reflected in the up and down. And we always refer this like a roller coaster, right? But interestingly, if we see the roller coaster is swing bigger, the bigger swing, then it is more volatile. And if we see the volatility is very big, we call it high risk. When the volatility is very low, then we call it lower risk. So volatility, as we see here, like the roller coaster, and then we up, down, and all this time, we always refer volatility to risk. So actually, if you see the volatility, why we call it as risk, actually in investment, definitely everyone has a certain target of return. And this is what we call the expected rate of return. And if we see this bell-shaped curve, the volatility is deviating from this expected return. So the vertical line is what we expect to have from the investment. But if our result deviate from this vertical line, it could be here, it could be here, it could be here, it could be here, then it is volatile because it's not it does not arrive at our expected return. So the wider the bell shape, then it is considered more risky. That's why we always refer volatility as risk, right? So if you look at roller coaster, because we always refer volatility is like a roller coaster, then what do you think? Do the people riding the roller coaster, do they enjoy or fear in the ride? Depends. I myself, I love riding roller coaster. When I go to theme park, normally I just like to see, okay, which one is the scariest roller coaster? Then we will ride this one and then enjoy. I myself enjoy roller coaster, and I believe all the roller coaster lovers all enjoy. Why? Because we know where the end point is. We will finish safely in the track. So when we know the full track of the roller coaster, then we can enjoy the. But imagine if you are going upside down, but it is in a car crash. I believe the story is totally different. So when we know the whole track, then we can enjoy the ride. And in investment, we also need to know the whole track. And what is the whole track when it comes to investment? This is what we need to think about. And in my 25 plus years of experience, I can conclude that the whole track in investment is long-term investment. So when we invest, always have the long-term horizon in mind. Okay, so if you look at this chart, this is a chart of Apple. Yeah, so this is an Apple price, Apple stock price. And you see from here, go down, go up, go down, go up, go down. So if you look at the movement, Apple stock price dropped almost 30% in 6 months. If this happens to your portfolio, imagine you lose 30% in just 6 months. What will happen? You may be fearful, like what Mr. Wong just now explained, right? But then, if you just happen to invest at this low, and then the price go up 36% in 2 months, then what will you feel? I believe you will feel excited. Maybe you will feel like you are the smartest person in the world. You can score 36% in 2 months, right? But then if you keep on going, and then the price go down again, and also drop 30% in 5 months, then you will, wow, volatility is very dangerous. You will feel like, wow, market is very destructive to my psychology, right? And if you see this movement, it almost occupies the whole screen. It's almost touching the upper end, and it almost touches the lower end of your screen. And you see, wow, volatility is very high. So how do we overcome this volatility with a long? So if you look at the longer time horizon, so this one is around 2020 to 2023, is around 3 years. So if you see the next slide, this one is around 5 years. When you see the chart in 5 years time, actually it does not occupy the whole screen. So the up and down is just a part of the movement. And if you look at the next chart, around 10 years, the one that we see is just the one block in the yellow color. And if you want to make it smooth, you see the red line here. The red line represents the moving average. And what I display here is the 100 moving average. So 100 charts average get 1 point. And then the next 100 chart get 1 point. So if you see the red chart, the red line, it does not display any big volatility at all. It is just smoothly going up. So we can only say, okay, we know that the long-term trend is up. Volatility, it looks big only in the short run. But when it goes to the volatility is not scary anymore. And if you look at the moving average, it will see like a very smooth line going upward. So, next please. This is tips number 1 to overcome volatility. Long-term investment will smooth out volatility. So always have long-term horizon in mind when you want to invest. That's overcome volatility, tips number 1. Okay, next please. Then, just like what Mr. Wong also mentioned just now, how do you want to invest? Maybe out of ignorance, and then you buy, and then you want to average down some more. So after some time, the price go down, you get confused, and then you cut loss. It could happen. I also experienced that, right? So what do we do with our money? Shall we buy now? Let's say, just now we displayed the Apple chart, Apple stock price. Shall we buy Apple at current price around 80? Or shall we wait for the Apple stock price to go and then we buy? Or how? Normally people will do, first thing is buy and keep, buy and hold. That's one thing of investing. The second one, they try to time the market. Timing the market means, okay, looking at indicators, looking at data, okay, no, it's not the time yet. And then when the price maybe move down, then you say, okay, this is the best time to buy. Or maybe, I don't know what indicator shows to your desktop, and then you make a decision. That's timing the market. But research shows that it's not easy to time the market, especially if you can say, I want to time the market consistently. I must remind all of you, it is not. So the third one is using dollar averaging. So with dollar cost averaging, you invest regularly. And how much do you invest? It's an equal amount. So let's say, okay, I want to invest every time I celebrate my birthday. That means once a year. Or maybe if you want to be more frequent than a year, okay, every quarter I will start investing. Or maybe every end of month after I receive my salary, then I will invest regularly. That's dollar cost averaging. So you invest regularly with the same amount. That means if, let's say, in your plan, in your investment plan, you plan to invest, let's say, $1,000 per month, then every month you will buy $1,000 of investment. And where to invest? Let's say we discuss about Apple. So you just buy Apple stock with $1,000. If, let's say, today 180, that means you can only buy 5 shares. If the price drop to, let's say, 150, maybe you can buy 6 shares, and so on. So every time you have to invest, then you invest with the same amount of money, regardless of the price of the security. So this is dollar cost averaging. So just now we remember there is buy and hold, or second, you want to time the market, and the third one is dollar cost averaging. So if you buy and hold, at the lowest price, that's the best. But it is not easy to get the lowest price. But if you buy at the highest price, then it is a disaster. So with dollar cost averaging, you try to average your price instead of one shot. So this is dollar cost averaging. Now, if you look at this chart, this is just an example of the regular interval. So I'm using the vertical grid line here, and this vertical grid line can be translated to any terms that you want. Just like we mentioned just now, it could be your every month end after you receive salary, or maybe after your birthday, or every, I don't know, as long as it is regular interval. Yeah. So if you imagine, let's say the price was here compared to here. So at the first point, you can get more shares than the second point. At the third point, you can get more shares than the first point. But let's say when the price is around the peak, then you get less shares. You just keep on buying, yeah, buy here, and so on, as long as it is dollar cost averaging. So with the amount of money you buying. Okay, next slide, please. And what is the benefit of dollar cost averaging? The first one, you will average your purchase price. That means you avoid buying at the top. Definitely, you will avoid buying at the top because you spread your purchases. The second one, you don't need to time the market. Timing the market is very difficult, if not impossible. Yeah. And since you do it regularly, you don't need to think when to buy. You can focus on your business and your expertise. And this is what I like. Like myself, when I invest, I don't need to think, okay, when to buy, when to sell. As long as you want to buy, just keep buying with the dollar cost averaging. Just focus on your expertise. You run your business, you run your company, just run it. So this is the dollar cost averaging. So next. Tips number 2, dollar cost averaging will reduce the impact of volatility. Why? Because you spread your purchases over time. Okay. Next slide. This one is interesting, and I hope you can get the idea of volatility. Next. Let's say you have asset number 1, and your asset number 1 is having return profile like the chart, like the white color chart. The return can go up here, can go down, can go up, can go down, can go up, and so on. If you have asset number 1 as your portfolio, is your return volatile? The answer is yes. The volatility is displayed like this one. And remember, We want to overcome the volatility. Actually, everyone would like to have fixed return, right? Absolute return. We want to have something really predictable. This is the fund manager's point of view, right? We want to have everything controlled, under managed, right? So if you see your portfolio having the return profile like this asset number one, then your portfolio is still volatile. The value can go up, can go down, and so on. So how can we reduce the volatility? Next slide. Okay, when we add asset number two, and asset number two has the return profile as the red color chart. So when the asset number one go up, asset number two go down. When the asset number one go down, asset number two goes up, and so on. And if we combine these two products or these two assets, then we can have an expected return, the green dotted line. So it's like a fixed return when we combine, because when this one produce this high, this one minus, okay, our return is here. When this one same, then our return is here. This one, the red one high, the white one low, our return is here. When we combine these two assets, then we have fixed return. Of course, it is not easy to get a totally negatively correlated asset. Yeah, because this one is, the correlation is -1, and it is not easy to find. But as long as you find the negatively correlated, then your expected return will be smooth. Maybe if not straight line, it could be like, yeah, the volatility will be very small. So what is the essence of these two assets? Basically, it is called diversification. Next slide, please. So when we do diversification, that means we would like to add our asset class. Remember, diversification must consider two things. Diversify by the asset class and diversify by the geography. By asset class means, as we know, there are 5 asset classes that normally people group, yeah? The first one is cash and cash equivalents. The second group is fixed income. The third one is equities. The fourth one is property and real estate. And the fifth one is alternative investment. So when you diversify, try to diversify among these 5 asset classes. In the equity itself, it is also have many things to diversify. If you just buy one stock, then it is also risky. You need to diversify among other industry, right? So this is the diversification by asset class and also by geography. By geography means if you put your money every month, every fund that you have only in Indonesia, then you have the country risk. This is what happens to me in '98. When I put all my money in Indonesia, and then the economic crisis happened. Even though the best company you hold, the price crashed. So you need to diversify by geography as well. Means, okay, you have portfolio in Indonesian stock market, that's good. You have portfolio in US stock market, that's good. Or maybe you want to have portfolio in China, okay, no problem, as long as diversify geographically. So diversification by asset class and by geography. 2 things you need to remember. And try to find negatively correlated assets. And negatively correlated asset, if you don't know which one to choose, the easiest way to diversify your portfolio is using index-based instrument. So let's say talking about, let's say, Indonesian stock market, which stocks to buy? Maybe you will mention, okay, this banking stocks, or maybe this commodity stock, maybe this consumer product stocks. But which one to buy? Maybe you are confused. Then you can refer to the index base. We have index LQ45, we have index ITX30, and so on. In US stock market, they have S&P 500, they have NASDAQ, they have Dow Jones. So this is one of the easiest way to diversify your portfolio. Okay. So tips number 3, diversification will reduce the volatility of return. Just like the chart that I show you, when you hold asset number 1 only, then the volatility of return is very high. When you choose asset number 1 plus number 2, then the expected return become fixed return. Okay, so tips number 3, yeah? Diversification will reduce the volatility of return. Then we look at this chart. This is the first chart that I show you about volatility, right? So when you look at this, actually the vertical line is your expected return, and the one in the bell shape is the probability of return that you might face. Talking about volatility, actually, if the volatility is here, that means you can generate more than you expect. Do you mind, or will you be happy to have this return when the return is higher than what you expect? You will be happy, right? So you don't mind to accept the volatility on the right. What you don't want is the volatility on the left. So you want to eliminate this left part. Next part. Yeah, the red color. Yeah, you want to eliminate the downside risk. You are okay with the upside risk. So volatility, wow, I expect to generate 10% and then it has 15%. I'm happy. But if you expect 10% and you only get 5%, then you don't want this to happen, right? So we want to eliminate the left part or the negative downside risk. So talking about downside risk, just like in insurance, we need to think from 2 parts. How frequent it happens and how severe if this happens. Let's say in our daily life, maybe we can easily get scratched. Suddenly scratch, and then you need to apply some medicine to make your skin recover, right? Scratches happen very frequently, but then it does not pose any harm to us. So when this happens, we are okay to accept the risk. But when it comes to something serious, let's say cancer, maybe heart problem, kidney problem, the frequency is very low, but when it happens, it devastates us. The severity is very high. So we want to protect from the high severity incident. Because if we want to insure, insurance needs money. Insurance needs cost, right? When you want to insure everything, then you may pay too much. Your cost will be too high. But if you want to insure only certain things, then your insurance or your cost will be low and it will protect you from certain severe risks, right? So, impact of the downside risk after you consider the severity and the frequency. So which one you want to eliminate? Is it the one around the center? Or is it the one on the tail? Definitely, we only want to eliminate the risk on the left side, right? Only on the outliers. If this one happened, oh yeah, I think still acceptable.
Oh yeah, the portfolio generate less. How much less? Oh yeah, it's around 5 to 10%. Oh, maybe it's still considered okay, acceptable. Then you don't need to hedge, you don't need to eliminate the risk around here. But what you need to protect is this risk, the outliers. Back to the next slide. Okay, so when you hedge, only hedge the outliers. Only hedge the outliers. This is to consider the cost. Because if you hedge everything, the cost is too high and the cost may exceed the benefit you get. Okay? Okay, next. So tips number 4, hedging can give you protection from downside risk. Okay? So if you review all these 4, next slide. Basically, overcoming volatility is simple. Use long-term, dollar cost averaging, and then which product? Diversified. And if you still feel unsure about the outliers, then you hedge the risk for the outliers. Okay. Any questions, ladies and gentlemen, from this?
Thank you, Pak, for the material. I want to ask, as a retail investors, how can we diversify geographically? I found some instrument that can be invested for US, but usually the license is Bapeti. So it's considered commodity. Is it safe for us using futures index that is regulated by Bapeti? And also how to invest for rest of the market, because right now China is emerging and also a lot of emerging market is good. So thank you.
Okay, thank you for the question. So interestingly, Indonesian investors can now access the US market. Government, through Bapepti, issue license to some companies to facilitate trading of the US stock market. So if you are looking for US stock index like Dow Jones, S&P 500, or NASDAQ, you can trade through futures broker. Like myself, I'm from Agrodana Futures, and my company is facilitating all these kind of products when we are regulated under Bapepti. And if you would like to trade the US individual stocks, Bapepti also approved some lists. Currently, there are around 100 plus of the stocks in the US that can be traded in Indonesia. And our company is offering 50 stocks. And these 50 stocks is all the top 100 market cap. So we can call it blue chip stocks like Apple, Amazon, Google, and then like McDonald's, maybe Chevron. So many companies in the US that you can also trade from Indonesia. So this is one of the way you can access the geographically. Before that, if you need to diversify geographically, then you need to open an account with overseas broker. But we know, right? When you open account with overseas broker, that means you have to send money abroad. Maybe the transfer fee is more expensive, and then not same day, and then the tax issue, legal issue because cross-border. But if you do everything in Indonesia, you can have the access with the ease of administration. Okay? Okay, thank you.
What about for other than US? Are there any ways for us?
Okay. In Indonesia, like myself, in Agrodana, we have access also to trade the Nikkei and Hang Seng. Nikkei represents the Japanese stock market. Hang Seng represents the Hong Kong. So currently in Indonesia, you can have access to Nikkei, Hang Seng, Dow Jones, S&P, NASDAQ. Previously, we have also the European stock index, like the FTSE for England and the German DAX. But the appetite from Indonesian investors is very low, that we only focus on this Asian and the US currently. Thank you.
Thank you.
Yeah. Any other questions? I hope with these 4 simple tips, it really helped us to overcome volatility. Always have long-term perspective, do the dollar cost averaging, using a diversified portfolio, and if needed, then try to hedge only the outliers. Thank you, ladies and gentlemen.